Hello everyone. Hello again, it's video time. I have 3 shorter videos tonight instead of 2 longer videos. Chapter 5, if you've read it, like I hope you have, has a lot in it. It's a lot of little things, little details. And we're going to do some examples in the next 2 videos that go into all of these little details. But I wanted to just kind of give you an overview and highlights for, I think, some of the things that I hope you noticed about the chapter, or I would like to explain some of those figures and things that you saw. In chapter 5, Smart Touch Learning goes from being just a service business that does computer training and that kind of thing, and they go into be a merchandiser or a retail business. And these are businesses that sell things. They don't manufacture anything, they don't make anything, they buy it from a supplier, a wholesaler, or direct from the manufacturer, and then they sell it to their customers. And we do everything the same way. The journal entries are we still can use dead coil, nothing changes. The only thing that it does by switching over to a retail business is it adds a few accounts. There are some new accounts that you'll be seeing throughout. Probably the most important one is called cost of goods sold. Cost of goods sold is what the merchandiser or the retail business pays to buy the goods that they turn around and sell at a profit. Okay? So whatever they pay for it is cost of goods sold. This is probably the most important number for a retail business. Okay? And it is the #1 expense of the retailer. Whereas before, when we were looking at service business, the #1, the biggest expense is normally payroll. Okay? For the merchandiser, it's definitely cost of goods sold. So you notice I'm sitting because I'm not going to be writing too much on the board in this particular video. Again, it's a short one, bear with me. I have a few highlights, and the first one is kind of on the second page of the chapter. It's on 247, figure 5-2. If you're looking at your slides, it's slide number 11. And you're going to see, if I put it up here, it's not going to do much good, but I'll do it anyway because I'm a visual person. Okay, maybe you can see it somewhat, but the book looks, I probably should have gotten the slide, it's bigger, but I don't have the slides in here. They're in the office, unfortunately, but this is page 247. What they're showing you is a I don't know how well you can see that. Yeah? Okay. It's a comparison of financial statements, at least the income statement and the balance sheet, for Smart Touch Learning, the service business, versus Smart Touch Learning, the retail business. And you might say, what happened to the statement of owner's equity, right? The second financial statement. Well, they don't show that because there's no difference in the statement of owner's equity, exactly the same. The balance sheet is the same, except now it has inventory on it. You're going to notice that's a new account on the balance sheet as an asset for the retail business, inventory. And they like to call it merchandise inventory. I'm a retail business. I have an auto parts store. We just call it plain old inventory. We have a gazillion different kinds of inventory. Smart Touch Learning is only going to have tablets. That's all they're going to sell is tablets. So it's going to keep it real simple, right? Straightforward. One kind of thing to sell, tablets. They're going to pay $350 to buy it. They're going to sell each one for $500. That means gross profit on each one is, they're selling it for $500 each, right? And they buy it, oops, too many U's? No. They buy it for $350 each. So the gross profit, which is sales minus cost of goods sold, COGS for short, equals gross profit. And you're going to see that on the top of the income statement, not these numbers. But this is the gross profit right here, and that's one of the biggest differences in the income statement between a a merchandiser and a service business is the top is going to show you cost of goods sold and gross profit. This is the profit before you take out all the other operating expenses that we used to, like payroll and rent and repairs and supplies and all those wonderful other expenses. You still see them, but they're listed separately. Okay? So if you look at that, you'll notice for Smart Touch Learning, their cost of goods sold was $100,000 and their gross profit was $130,000. So you can see their net income went from $114,000, right, for the 2 months ended November and December, and now it's down to only $14,000 because they had to buy the tablets, and that was cost of goods sold. If you look down the bottom at the balance sheet, it's really exactly the same. The only thing added in is that inventory. They have $60,000 worth of inventory at the end of December. Okay? That's what they didn't sell. That's what they have in stock. It's very important for a retailer to always know what cost of goods sold balance is and what the inventory balance is. And because of that, we're going to be using the perpetual system only. You'll notice as you read on, and this is starts on page 248, where they talk about the two inventory systems, perpetual and periodic. Periodic is in the appendix. Don't even bother with that. No one uses it. It's very inefficient. It's in order to find out how much inventory you have, you got to go out and count it, okay, physically. Because the only thing good about it is it's a lot easier. There's less journal entries to make. It's accounting-wise, it's much easier, but it doesn't give the retailer the information that they need. Perpetual, that word means always. So in the perpetual inventory system, you always know what the cost of goods sold is, and you always know what your inventory is at any point in time. The balance is going to be there. Okay? So you'll see that on page 248. And they do spend the whole chapter talking about perpetual. Again, that's only kind we're going to use. When I was a student, we learned both kinds, and periodic, totally useless. Don't even bother. So the next part I wanted to show you is 240. Let me see. Okay. Wanted to mention they spend the next few pages explaining the purchases. Smart Touch is going to purchase inventory, and that's pages 248 to 255. They explain all about purchases and discounts. A lot of retailers offer discounts for early payment. A lot of sellers to retail businesses offer purchase discounts. In other words, you pay by a certain date and you can take up a cent off. Everybody wants to take discounts, so it's a big deal. So they do explain it, and again, you're going to see it in my next video. We're going to do an example of buying and selling, so I'm not going to spend a lot of time here talking about it. I'm going to do a full problem with examples on both. So you will see the purchases part, which is easier, on 248 and 9 up to 255, and then the sales, selling things to our customers, 256 to 261. And again, we're going to do examples of buying and selling coming up in the second video. Okay? So, what I wanted to show you from this selling side, you might say, well, I read this and I'm still not sure how the perpetual system actually tells you what the cost of goods sold is and the inventory is at any point in time. How is that possible? This is how it's possible. If you look at slide 537, or if you have your book open on page 257, okay? Down at the bottom, I always show this in class because I have a name for this. I call it the double entry of the seller. I made it up when I was a student just so I would remember it, and it worked. I never forgot it. I still talk about it all these years later. But the double entry of the seller means you need two Every time you sell merchandise to your customers, you need a double entry. Okay? You don't need it to purchase, but you need it to sell. And this is the magic bullet, so to speak, that makes the perpetual system work. I'll show you what I mean. Okay, they have an example down the bottom. Smart Touch sold 5 tablets for $500 each to a charge customer. It doesn't name them like it often does. This one just says it sold it to on account. And the cost of goods sold was $17.50. They always tell you, usually in 2 sentences, sold this on account for this much. The cost of goods sold was this much. It's normally in 2 sentences, not always, about 99% of the time. But even if it isn't, even if it's all in 1 sentence, as soon as you see sold something, look for that cost of goods sold. That's going to be your second of the double entry. So if you look, and the answer is right here, but they want to show the journalizing of it. So what you would do for this one, in any sale, either cash or charge, this one happens to be charged, so you would go accounts receivable, right? And they sold 5 of them at 500. Makes it nice for us, they sell them all for 500, right, each. So we're going to debit accounts receivable, AR for short, for 2,500, and we're going to credit. Now we're going to call it sales revenue, of course, instead of service revenue. That's one of those new accounts, because now we're in the sales, we're selling. That's the first of the double entry. Really no different from before, except we used to call it service revenue in the first 4 chapters. But we're not done. If it was periodic, we'd be done. But periodic doesn't tell you anything about the inventory leaving your building and going to your customer, or how much that cost you in what you had to pay, and now you have to replace that inventory. Okay? There's a lot more things to worry about when you're a seller than when you're just a service business. So the second of the double entries, I always abbreviate cost of goods sold as COGS. This is always the second entry. Whatever you paid for it, they paid $350. So 350 times 5 is $17.50. And then we're going to credit the inventory. I'm going to abbreviate it merchandise inventory because it's so long to write. This is right in the book and right on your slide. You might say, why are you doing this? Because I can see it. Well, I just kind of want to highlight that this is probably not even probably, it is the most important thing that makes perpetual inventory work, and it works like a charm. Because once you've done this, you've updated your cost of goods sold, so you know where that's at. And you've also credited or lowered your inventory for what's gone. So you could look at your ledger anytime and see the balances, right? So this is very important for ordering, for pricing, for everything. So this is very, very important. And I call it the double entry of the seller. No one else calls it that. But if you choose to remember it like that, that's fine. Or however you want to remember it. So, what else do I have for you? Not much. Okay. There's closing entries on page 262 to 264. More closing entries, aren't you excited? We are going to do the 3rd video on a closing entry problem, only because it also has a multi-stepped income statement that I want to show you. Not so much as I want to give you more closing entries, but the good thing about the problem I'm going to show you, it's a lab problem, not one of ours, but it's another one. But it's like one of ours, and it's short. It gives the point. So let me look. The closing entries for Smart Touch, and it's a beast. Smart Touch has a lot of accounts to close to 0, lots of expenses, and the same steps we're going to use. So if you want to check that out, ours is going to be much shorter. Again, 260, I wrote it down, slide 526, oh, I'm sorry, I forgot one thing, I'll go back. Page 260, nope, that's wrong. Closing entries, start 262 to 264. Okay, before, so you can check that out, and we are going to do one. One other thing I wanted to mention quickly is the shipping point and destination. There's shipping charges to get freight from one place to another, from the buyer's place of business to the seller's place of business. Normally that's by truck, okay? Could be UPS or Federal Express or those big trucks you always see. That's what we have at our place, but we also have UPS and FedEx. But there's always big trucks outside delivering and picking things up. This costs money, right? And on slide 526 and on page 254, I'm sorry I'm backing up. It was written so tiny, I squeezed it in. I didn't see it right away. The only thing you really have to know about shipping point and destination is if you see in a problem shipping point, that means the buyer is responsible for paying for it. If you see FOB destination, the seller is responsible for paying for it. That's all you really have to know. I know there's a few pages about it there, but that's really all you have to know. Sometimes, as a courtesy, the seller, right, will prepay the freight for you, even if it's FOB shipping point. And then you'll pay the seller back when you pay for the invoice. And we're gonna see that happen. But the thing to remember about shipping charges is you can never take a discount on shipping. You can take a discount if it's offered by your seller, but you can't discount the shipping charges. Never, ever, ever. It's always the full amount, okay? So if the seller is prepaying and offering a discount, you can pay them back taking the discount, but then you have to add the shipping in full, okay? The last thing before we're done this video is there's a nice multi-stepped income statement on page 266. Of course, I use that term loosely. This is Smart Touch's multi-stepped income statement. You can see it's kind of long. And the reason I'm pointing it out, ours is going to be shorter, the one we're going to do, is you can see the top step. They call it multi-step because of the cost of goods sold, you know, and the gross profit. And also there's one step at the bottom they added on. And we'll talk about that in a second. You can see for, this is slide 559, page 266, exhibit 5-8. Why I'm pointing this out is you look at the operating expenses, they're split in two. Half of them are selling and half of them are called administrative. The only difference is just as you would think, selling expenses are expenses that happen because of selling products, and anything else is called an administrative expense, such as office types expenses, right? Things that happen outside of the selling realm. So they're now going to be separated into two sections and totaled for total operating expenses. You can see once they're deducted, they're totaled and deducted, we get operating income of $110,420 for Smart Touch. And you might say, how come they're not calling it net income like usual? Well, that's because there's another step. And it's called other income and expenses. It's at the bottom. And what is other income and expenses? Just as the name kind of suggests. It's income and expenses or expenses that come not from your regular line of business. For example, interest expense on a loan is a other type of expense. It should be segregated and put at the bottom. It's not from your regular line of business. And that's what they're mostly going to give you here. You see sales discounts forfeited as a plus. This is people that didn't take the discount within the period and they had to pay you the whole thing back, the whole gross amount. This adds to your sales. This is kind of an adjunct account. It goes with the sales revenue. It increases on the credit side. It's a good thing. Well, it's a good thing for you. If they don't pay by the discount period, 10 to 15 days usually, then they have to pay the whole thing. Okay, I'm gonna ignore that. Probably my son. They're gonna pay the whole thing, and when they, okay, my daughter. We'll call her back in just a minute. So anyway, I lost my train. We're going to see sales revenue, sales discounts forfeited for people that couldn't take the discounts and that, or didn't make the time frame. They had to pay the whole thing. And we're going to see interest expense. What else would you see here? You don't have to worry about it right now. It would be gains or losses from selling